Good afternoon, everyone. Welcome to today's market stream. My name is Stock Darts, and we're going to do what we always do on Wednesdays. We're going to go ahead and take a look at the four major market indices. We're going to look at the S&P 500, the Nasdaq Composite, the Dow Jones, and the Russell 2000. Now, once we finish examining the markets, we'll take a quick look at the U.S. dollar. We'll see how it's affecting not only the markets, but oil, gold, and silver, and Bitcoin as well. And then we'll move on to chart requests. If anyone in here has a chart request, feel free to type it into the chat tab, and I'll be more than happy to take a look at it once we cover the markets. If you like what you see here, if you're watching this as a recording, you can always visit me at Twitter under the name Stock Darts, and I'll be more than happy to interact with you there. You can also visit me on YouTube under the same name, Stock Darts, or you can visit patreon.com/StockDarts, where I post weekly blog content, including trade ideas, watch list ideas, the reposts of these Wednesday market reviews, and anything else that I come up with during the week that maybe catches my interest. That's probably the best place to look. Again, if you're interested in the style that we go ahead and offer, the way I approach trading, the way I approach the markets, that's probably the best place to go. On that, let's go ahead and get started. First thing we're going to do is analyze the markets through looking at the S&P 500 through the ETF SPY. As you can see, the markets have held up very well over the last couple of weeks now, despite the fact that they've been kind of in this corrective posture. We've had a couple of days of selling, but for the most part, we've just kind of held up at highs, and just kind of consolidating and taking some profits without actually correcting downwards in price. We're just basically correcting through time, which is a good thing. Again, it shows that the sellers have little impact on the market right now. For those of you that visit every Wednesday and follow and pay attention to what we analyze in the market, we had seen the shift in character in the market once we broke this 397 level. You remember we had this outlined as a key point of contention, and prior to that, you can see we were kind of consolidated in a pretty volatile manner, and the markets and the price action in the markets was actually threatening to kind of taper off and start trading sideways and kind of give up on the rally that we had experienced since the holiday season in 2020. And instead, once we broke out of that, it was a clear signal that the bulls had regained control of the price action and had, basically were ready to push it back up. And that's what we've seen. Now, I think we're starting to get a little tired again. I think we've been tired for a week and a half now. As we started to approach this level around 415, back in April 15th, we started to taper off, and as you can see, we've just been kind of going sideways. Now, part of the reason for that is, one, markets are getting overbought, a little bit overextended, but also, two, we're kind of doing this holding pattern where we are waiting for important earnings, and we've reached the point where those important earnings are going to take place. We had Google report yesterday, and it had a good report. We have Facebook, Amazon, and Apple reporting either today or tomorrow afternoon. We've already had Netflix and we had Tesla, so we're starting to come through the meat of earnings season now, and I imagine the next 2 days are going to be the most important earnings as far as what the market is going to do and whether we react well or negatively towards them. If we react positively, well, as you can see, we've already consolidated a decent amount of time, and we could be breaking out if Amazon and Apple in particular have good reports and are able to prop the market past that. Now, if they have poor reports or are poorly received, regardless of what the numbers are, then we pull back. However, with the action that we've had here, we've got a couple of areas now that are developing as potential support that could support the market without us having a real strong pullback. Now, even if we had a real strong pullback, it would still be within the framework of an overall bull trend, not only in the long term, but even in the short term. And so there is room for us to pull back and still not really put any kind of impact on the price action that we've seen that began, like I said, back in the end of October, beginning of November of last year, when you can see we just started to climb and really rally very steadily throughout the course of not only the end of last year, but as you can see, the momentum is carried on throughout the beginning of this year. And we're already through one quarter, and as you can see, the market continues to kind of push upwards. And so overall, it's still a very positive outlook for the markets. And really at this point, even though I still think that there's a good chance that this rally will die down soon and will kind of transition towards the more sideways price action, maybe as we head into the middle of spring and beginning of summer. But for now, that's not what's happening. And so, like I always say, you have your own theories or your own framework of point of reference of what you expect the market to do. But in the end, what you want to really do is just react to what the market gives you. And so a lot of times when we analyze the price action on these Wednesdays, I try to give you a couple of different points of view. One, obviously, what I would consider the more likely event, but two, if that weren't to happen, what would happen next? And then what we do is we try to outline plans of attack in case we get one or the other, right? And if, sadly, for the last almost decade now, really it comes down to two things: you either buy momentum or you wait for a pullback and you buy the pullback. And until we see a very different change in character in the price action of the market, we're going to continue to do the same thing. You don't always get a market like this to just kind of climb steadily, and when you do get one like this, you want to go ahead and take advantage, right? And make sure that you take whatever profit you can get from it, because there will be more difficult times, as we experienced in the beginning of 2020, and even to a certain extent in the middle of it. And so when you have a market that's steadily trending in a nice channel like this, you want to make sure that you take advantage of it and take advantage of the upwards bias and the upwards momentum as you go ahead and follow it along. And there will be weeks where you're a little bit more aggressive and weeks where you're a little bit more cautious, depending on what the short-term price action is giving you. But for the most part, you don't want to get too big-brained on it and try to do something, get too cute and try to do something that's counter to what the market is giving us. So in this particular case, you don't really want to short the market at this point. Even when the market was showing us signs of negative price action and of the bears starting to take a little bit of control of the price action, it was still a bad idea to try to sell, because the overall framework and the overall momentum of the market was still steadily climbing, which meant that even if you timed it perfectly and got a good sell, you would have gotten maybe one or two candles of price action before the bulls came in and stepped up, because there's a lot of demand that is still underneath the surface here, and we're seeing that again, as you can see, just the last week, where we get a couple of days of selling and right away there's a big rebound with a big green candle as buyers step in, because they want to buy, but they don't want to buy at the absolute highs. So as soon as they see just a little bit of selling pressure, they immediately jump in and buy. When you have that kind of demand underneath the surface, you want to take advantage of it by buying pullbacks or waiting for breakouts. You don't want to try to short the resistance, even if you have a really good, really strong feeling that it's going to pull back. Well, if that's the case, then just wait for the pullback and buy the pullback, rather than try to be the guy, the hero that calls the short that actually works, which up to now has worked. A really good short trade has only worked maybe once in the last, I don't know how many years now, and that was really because of sort of a black swan event with the coronavirus and with COVID-19. And so if you didn't happen to have that affect the markets, you generally have been wrong trying to short the market for a long time now. Now, if we analyze the S&P 500 in a vacuum, and we're not going to look at the other indices yet, we're just trying to figure out what to do with SPY. Well, like I said, if we do sell off, if we have poor earnings in the next couple of days, well, the first pit stop will be the 20-day moving average. As you can see, we've already kind of developed this as a short-term level of support. It was where we kind of brushed up against the top of this channel and started to really just stall off and start to trade sideways. And chances are, if we pull back, if we have really poor earnings, we'll probably pull back to here, stall for a minute or two, and then drop again. The more significant price point where we can expect strong support right now is this key level right above, or right below 400, right around 398, 397. Like I said, this was a pretty key resistance area that we broke out, and there was a very big change in character in the market dynamic once we were able to push past that. And so that is going to become the key line in the sand for us as far as the S&P 500 is concerned. It will also kind of coincide with the 50-day moving average, which, as you can see, has been a pretty good floor for the price action since we started really climbing and kind of rallying upwards on the S&P 500. And so those 2 points of reference will become kind of the key battlegrounds for the bulls and the bears once the bears actually take control of the price action and start trying to push it down. Now, again, if we get a good reaction and we break out, well, I mean, there's nothing I could really point out as resistance, right? Because we're at all-time highs. We're at the top of the theoretical resistance we could kind of extend, which is the top of this channel. And as you can see, we've been flirting with trying to break out above it and kind of accelerate this trend for a few weeks now. This doesn't normally work. Normally when you try to accelerate a trend like that, it kind of falls back. But sometimes it doesn't. So we want to keep an eye on that and see if we do break out. Like I said, chances are we'll get a green candle up, and then we'll retrace and start riding this as instead of as resistance, we'll start riding the bottom, this channel as the bottom of a support level as we kind of climb up. Probably the more likely event is that we come back and test the 20-day moving average and maybe the 50. But like I said, we want to wait and see what these earnings reports give us and see how we can go ahead and take advantage of that. If we look at the Nasdaq, and again, the Nasdaq is going to, of course, be even more affected by these reports because these are all big tech names that are reporting. Like I said, we'll take a quick look. Go to Facebook real fast. So look at our FANG stocks, right? You take a look. You've got Facebook reports tonight or today in the afternoon. You've got Amazon, which reports tomorrow. You've got Apple, which reports today in the afternoon as well. Netflix reported last week, and it was a poor report, and you can see they're trying to stabilize here. And then finally we had Google, which reported yesterday, and as you can see, they had a good report, and they're up about 4% today, and continuing the really strong price action that they've had throughout the course of 2021, which has been kind of in the face of what we're seeing in the Qs, because the Nasdaq has actually stalled out in 2021 as far as, in reference to what the other indices are doing. Now, it did play some catch-up, and as you can see, we are pretty close to all-time highs on the Qs, just like we are on the S&P 500. As you can see, we're just a stone's throw away from there. And just like the S&P 500, we had a breakout. We pushed past a really key level here, which in the case of the Qs was 324, and made our way right back to highs. And as you can see, just like the S&P 500, we've been consolidating in a pretty sideways fashion, pretty benign manner over the last couple of weeks as we just wait and take a pause for these earnings reports to kind of take place. This is what often happens as we approach the big week of earnings season, which is when the big names report, is the market sometimes takes a little bit of a breather, waiting to see what the reports are going to say. And, at this point, Apple and Amazon, Google, like these are big impacts on the overall market. There's a reason we follow the FANG stocks, is they for this point encapsulate what our economy is about, and really are a good bellwether for what the overall markets are going to do. And so, we'll wait to see what they do and see how they react. And then, like I said, it'll have a big impact on the Qs. If they're positive, then we'll break to new highs. As you can see, like if we put a new little rectangle here, we've had a nice, despite the fact that it feels like the market is still overbought and still kind of overextended, we've had a nice consolidation range here. We had a nice breakout. We've got a nice little bull flag, and we even have what happens often at the end of a bull flag, which is you come down, you test the top, and then you consolidate near the top of the bull flag right before you get ready to break out. So this is a bullish stance, and this is a bullish formation, a bullish continuation pattern that could very easily resolve to the upside and give us a new breakout and a new leg up in the rally that we are starting to really develop. Now you'll notice, in contrast to the S&P 500, the Nasdaq has done a little bit of a different thing, right? Because it had this channel and it broke down and actually it graduated towards a more sideways stance or more neutral environment, rather than continuing the sort of pervasive climb up that we've seen on the S&P 500 and we'll see on the Dow Jones. This was a function of the rotation that we had seen, particularly in the first quarter of this year, where money rotated out of a lot of tech names and out of a lot of the stay-at-home stocks into the quote-unquote recovery stocks, the names that really suffered last year and that should benefit from, our population getting more and more vaccinated every day, and more people becoming a little bit more emboldened to go back out and start, shopping, traveling, working, that sort of thing, and not staying at home, kind of, making sure that they're not getting sick. And so that was part of what happened here, why the Nasdaq kind of stalled out. It finally did recover, and money rotated back into tech names, as you can see, and we had the big run up. We're still kind of going through that rotation right now. There's kind of a messy mix right now where there is money rotating into tech names, but at the same time still staying with recovery names. And so we have maybe not the clean move that we had before, where it was very clear where the momentum was coming in. At this point, we're starting to see momentum kind of come in and out of areas a little bit more quickly and a little bit more erratically, which is what led me to believe that we might be going into more of a sideways type of market. But until we see that happen, we just have to continue playing the momentum to the upside. And in all honesty, even once we do get to a more sideways market, we're still going to play momentum to the upside. We'll just do it off of more value-oriented setups and more support plays at the bottom of a range rather than at the top. Because in the larger framework, like I said, if we look at the weekly chart, we're still in a very strong long-term bull trend, and there is a long way to go before we even worry about whether this bull trend is going to be intact or not. If you look at it from 340, we can go all the way down to 208, and we're still holding the breakout that occurred last year before COVID, when we had already consolidated for a 2 or 3 year span and traded sideways. And so, as you can see, in the long term, we have, and again, I could just keep scrolling farther and farther back, and it just becomes even more and more evident what a massive bull trend we've had over the last more than 10 years now. And so, until we see a difference, a big change in character, there's no reason not to trust that the bulls are still in complete control of the market, particularly in the long term. So even if we do lose this rally, even if we start trading sideways, it's still going to be a market where we want to go ahead and buy dips, where we want to go ahead and take advantage of value plays. It just becomes a different priority as far as where we want to go ahead and put our plays and structure them, whether we want to do it at value, how quickly we want to take profits, that sort of thing. But it's gonna take a lot of convincing from poor price action before I'm willing to recommend shorting in a public space like this again. Now, again, it's not to say I'm a permeable that doesn't like shorts or thinks that shorting is un-American or wrong or anything of that nature. It's just not a good time to short. It hasn't been a good time to short for a while. And as long as our governments continue to be fixated on manipulating the money supply to keep their stock markets propped up high, we're going to just go ahead and keep taking advantage of it. If they want the market to go up, then we're just going to take advantage of the market going up and try to make sure that we recover enough from our portfolio to offset whatever losses we're getting from our decaying dollar. And so in this particular case, like I said, even if we do pull back, I'm still looking at buying the dip. I'm still looking at playing to the long side. I'm just waiting for the right support areas to develop. Now, with the Nasdaq and with the Qs, what are we looking for? Well, we've got the 20-day moving average coming up to meet price, so that's not really going to be a really good functional support level for us to watch if we do pull back, because we'll likely pull back through it. As you can see, we've got this very short-term support around 334. If the Nasdaq, if we have a pullback because of Apple and Amazon and Facebook, it's going to be felt more in the Nasdaq than the others. So I imagine that we lose this and come straight down to this area around 329, and more likely than not all the way down to the 50-day moving average and the more important support level around 323, 324. Right, and so that becomes the key area that we don't want to lose. And like I said, if we do pull back in the next couple of days, it is probably because of poor reports from the tech names, which means that the Qs will feel it probably a little bit more strongly than what we would maybe see in the S&P 500 or the Dow. Although again, these names are big components in those indices as well. However, I still think the tech names will be, it'll be the Qs that feels it first. And if that's the case, we likely blow right through the 20 and come down and maybe take a pause around 328, but more likely than not, we'll have to come back and revisit the 50-day moving average. And like I said, the Qs have already kind of moved towards sideways chop, and even if we do pull back, I don't think it's indicative of top. I think it's more indicative of a market that's going to range sideways. Now, if we do break out, well, then this just was a temporary blip in the radar. And then we're just right back to the races. And this often happens. This is a pattern that develops a lot when you're looking at a bullish stock, where you have a nice rally like this, and then you get the breakdown, and immediately traders think, well, that's it, the run is over. This thing's gonna top out, and it's gonna just continue to drop now. And what ends up happening is you get this consolidation range, right? You get the breakdown, you come up, you retest that breakout area, you fail, you come right back down, and then you start chopping, and it looks like you're just getting ready to roll over and head lower. And then once you get this breakout and you kind of leave this behind, what you end up doing is it's a fake out that traps a lot of traders that maybe got out or tried to short because they lost faith in the stock as it moved up. And this will happen a lot too. A lot of traders go through this as well, where they miss something like the, whether it's the Qs or whether it's an individual stock. They see this rally and they tell themselves, "Oh, I can't believe I missed buying this at 296, or I can't believe I missed buying this at 300." And they tell themselves, when it comes back to 300, I'm going to buy. And then what happens? It comes down to 300, and they're like, "Oh, I don't want to buy this now. This thing looks terrible," and so they miss it, right? And as it starts to break back out, they panic because they missed it, and so they chase it up, and that fuels the momentum to push this up, regardless of whether other people got caught short or not. You still have this momentum that starts to develop because traders are, they're fearful that they've missed out on this big move and that they didn't get the price that they wanted, and so they chase it up, and that's what leads to these ascending wedges and these kind of runs up with very little impact from the sellers, is because there are so many buyers that missed their opportunity once it was consolidating. And this often leads to strong trends to the upside and continued moves that maybe it looks like a stock is trading sideways and it's not. It's just taking a breather before it makes its next leg up. And so, like I said, a lot is going to depend on what we see out of the earnings over the next 2 days. And we'll see pretty clearly whether we break out or we don't. If we don't break out and we start to pull back, then we likely need several weeks to probably kind of take a breather and maybe figure out where our next level of support is, whether we're going to continue stair-stepping or whether we need to come back down and test these lower areas. Now again, I think at the moment, the 200-day moving average, this 300 price point, I think they're not on the table. I think at this point, what's on the table is, if we do get a pullback, is this 324 area. And if we get a breakout, well, we're just going to push right through 341 and make our way up, and probably a nice big green candle, and then use this as the next floor once we do pull back. So, let's keep an eye on the report, like I said, today in the afternoon and tomorrow, and this should give us a much better gauge as to what we can expect out of the overall markets, and obviously out of the Qs, as the big tech names are going to be the more important ones. Now, if we look at the Dow Jones, you can see again, not like the Nasdaq, but more like the S&P 500, we've had a strong rally, and I think this is a good example of when an acceleration of a rally actually stuck. Right, you can see, like I said before, usually when you're in a strong, nice 45-degree sloping channel like this, when you try to break the upside and try to like accelerate and make it kind of like you're shifting gears up, that doesn't normally hold. And as you can see, it didn't hold for very long, and we came right back down and hit the 20. However, it then bounced very strongly again and was able to kind of make its way back up and then hold this sort of new level of this new trajectory on the overall Dow Jones. And so what we're doing now is we're still kind of working off of that. You can see we're still basically trading off the remnants of the previous channel and this new channel that it's forming. It's pretty tight. Now, just like the Nasdaq and just like the S&P 500, we've actually spent 2 weeks now consolidating in a pretty nice manner, which means that we're not really as overbought as maybe it feels like, right? And this has happened perfectly on declining volume as we kind of come back and test the 20-day moving average, maybe test the bottom of this newly developed very short-term channel. And so there's plenty of opportunity here for a momentum breakout and for an extension of this new trend upwards on the Dow Jones. So just like with the Nasdaq and like I said with the S&P 500, let's see how earnings over the next 2 days affect the markets, and if we break past 341, well, we're off to the races again, and we're just going to continue the same price action we've seen already over the last several months. Now, if we get poor reports, well, then just like the Nasdaq, we're already at the 20, so that's probably not a level of support we can really worry about. Probably what happens is, again, we don't sustain this expansion of this momentum for too long, and we just pull back. And we come down and we test the 50-day moving average. And then maybe even we extend this trend line out a little bit more, and we worry about what happens at that trend line. But I think at this point, when you have a rally like this, usually the moving averages are more important. And so probably if we lose the 20, we just come and test the 50. And then I think the price reaction at the 50 will be more indicative of what we can expect next, and see where we go from there. However, like I said, it's pretty much a coin flip. This is part of the reason why it's difficult to trade during earnings season, is it's not easy to gauge what's going to happen in an earnings report. Even if it's a stock that you have a lot of faith in, it's very strong fundamental, Even when they have blowout earnings, they sometimes have very poor reactions to the report because it was already baked in and the market was already expecting that. And there are also times where I've seen very, pretty poor reports where they miss their numbers, but it still rallies. And so it's very difficult to kind of predict what's going to happen with the overall markets. And so, there's a lot of uncertainty that comes into play when we're trading during earnings, and that's part of the reason why I usually kind of take a couple of, I take a break during earnings season. I don't really take too many directional swing trades, whether it's the overall markets, whether it's individual names, is because there's a lot of volatility that's very hard to predict with earnings. Now that doesn't mean that I don't like to trade during earnings season. I do. I like to trade earnings trades because I found that while it's pretty difficult to predict the direction, it's actually not that difficult to predict volatility. And a lot of names have very, very familiar, and I don't want to say too predictable because there's still uncertainty with any kind of trade. There's no such thing as a guaranteed trade, but I feel like there's a lot of names have pretty predictable behavior patterns as far as volatility is concerned during earnings season. And if you know how to trade non-directionally and just trade volatility and premium, then you can get away with trading during earnings season during the earnings reports. But if you're not good at that, or it's not the kind of style of trade that you like to take, then it makes sense to kind of back off and wait to see what happens. And like I said, with the next couple of days, there's a pretty big coin flip as to what the market's going to do next because we don't really know how we're going to react to Apple's earnings and Amazon's earnings. And so it could be that the market loves it and we just take off, or it could be the market expected more and we kind of pull back. And so for the moment, what we have a very clear range. We have a nice bull flag, and if the bull flag materializes to the upside, we'll get a nice rally and we'll know. If it fails, well, then we'll get a pullback and we'll have to come back down to support. But again, I would still consider this a buying opportunity. It'll just be a different style of trade, right? Instead of a momentum breakout, we'll be looking for a pullback to support and a pullback to a good area for buy the dip play. Then you just wait for a reversal pattern. But other than that, I think those are the two main levels with the Dow Jones we want to watch: is a breakout above 341 or 342, or a pullback down to the 50-day moving average. And if we do get to the moving average, likely we'll get a bounce to the 20, and then see what happens from there. And finally, the last index we want to watch is the one that's kind of like the black sheep of the family, and that's IWM. It's the small caps, the Russell 2000. And as you can see, it actually is a little bit more reminiscent of what we saw with the Nasdaq. It's very strange that the two indices that have had the big shift as far as rotation have kind of printed the same pattern. A lot of small caps did well when money rotated out of the tech space and into the recovery names, and yet this is the only other index that has also basically started trading sideways and lost its upwards trajectory. Now, unlike the others, IWM has not come back and revisited its all-time highs yet. We're not that far away. It's not like it's in a negative spot here. And actually, when you compare what we were looking for last week it was underneath the moving averages, and we knew that it was important for it to get back above the moving averages. If not, it was going to come right back down and test this low area around 208, this was kind of the key level to watch last week, was how the small caps were going to behave as money rotated out of them and back into tech. And for now, they gave us a good answer because they bounced, they got back above their moving averages, and they're kind of slowly climbing their way back up towards their all-time highs. Now, the key here with the moving averages is that they follow price up, and we see the 20 start to climb up, and we see the 50 turn up again as price starts to break past it. Until we see that, we'll have to assume that just like the Nasdaq, we're still kind of trading sideways and waiting for a better breakout. Now, again, it could happen in the next couple of days, and if that's the case, then the moving averages will kind of follow suit. Remember, these are lagging and will always follow price action. They won't lead price action. So if we start to see the market push back up and we see the concurrent move on IWM, then we'll likely see the moving averages start to align themselves in a way that indicates a new trend is probably forming. And at that point, then we can get behind a stronger rally in IWM and start looking at small caps in a different light than maybe we have in the last couple of weeks. Like I said, we are in the middle of a rotation, and oftentimes during these areas, it gets difficult to predict, or it gets a little bit choppy. I've compared this before to those of you, I don't know if anyone here likes the outdoors, or I don't know if you live somewhere where there's a lot of water, but I live in Miami, Florida, and there are parts where you can see the current, whether you're going out kayaking in the ocean, or whether you go to the Everglades where you have a lot of little channels. And if you ever reach a spot where there's two channels that meet, whether it's a little channel in the Everglades that goes out to the ocean, or whether it's just two waterways that kind of circle around an island, when they meet, the water gets muddy, right? Because you have these two different forms of momentum that are meeting together, and that's what's kind of happening right now with rotation, where you have a lot of capital that's flowing into recovery names, and you have a lot of capital that's flowing back into stay-at-home names. And neither one has really gotten the clear message that one side or the other is supposed to win. And this happens with bulls and bears. This is exactly what happened in February, March, where you have the bulls that are expecting to move up, and you have the bears that think we've gone too far up and we should drop, right? And so what ends up happening is you get these two currents that meet, and when that happens, you get muddy water, right? And you get this choppy price action, and that's what we've kind of experienced, not only in IWM but in the overall markets. And so what we're seeing right now with the small caps in particular, I think, is kind of the remnants of this shift back to stay-at-home stocks, where they've started to recover a bit, where you have some traders that are still full-fledged on the recovery name, a recovery trade, and you have others that are kind of flowing back into the stay-at-home trade and looking for those names to kind of recover some of their lost momentum. And so when that happens, you get this muddy water, you get a lot of choppy back and forth price action. In order for this to change and for a new bull trend to materialize, we're going to need a more steady rotation back into small caps, whether it be energy-related names, whether it be biotechs, whatever it is. But we need more small techs to regain momentum in order to start pushing IWM back up towards the highs and towards new ones. Until we see that, we can assume that unlike the other indices, this one is actually consolidating. And we'll see a pretty clear picture once the moving averages align themselves in a similar fashion to what we saw back here in October, where you had them going sideways, and then once they start to slope up and you see the 20 start to climb while the 50 spreads out below it, that's usually when you see a good trend developing, and obviously we're not seeing that yet. So we're at the very beginning of it, or possibly not even at the beginning, and possibly still in something like this, where it looks like it's the beginning of an uptrend, but it's not. It's still just a sideways trend. So of the four indices we just covered, I think the small caps are probably the least likely area to give us good returns at the moment. But like I said, we'll see what happens as we see more earnings reports come through. We'll get a much clearer picture of what the price action is supposed to give us and what we can expect next. Now, the key levels to watch on IWM, obviously all-time highs around 234 or so are going to be the critical spot for us to break out from. Now, support, the key area here is the 223, the 20 and the 50. If we lose those, then we're probably going to come right back down. Now, there's a new trend line. I don't want to really keep it up, but we can maybe watch this trajectory and see if we do lose the moving averages. If we hold this trajectory and don't come back and lose this tweezer pattern here at 215, then I think it's still positive. But if we lose this level around 215, then we're going to come all the way down to 207. And then we're going to be right back in that scenario that I pointed out last week, which is if you're worried about the markets and you think that there's a chance that the markets pull back, the first area that likely this will occur will be IWM, and it'll likely be this 208 area. And so that'll be the kind of the signal that we're shifting towards a more sideways environment, is if the small caps are the first ones to do it. Like I said, in the very short term, in the next day or two, the more likely index to pull back would be the Qs if it's poor reports from Apple and Amazon and Facebook. But even then, I think IWM will get hit too. And like I said, I think this is the key level to watch as far as IWM is concerned, and to a certain extent, as far as the markets are concerned. Now, the key level to watch on the upside would be the Nasdaq, and it would be the all-time highs, right? So this is the key area that we want to watch in the next couple of days. If we break 342 and start to rally, then I think it's going to be indicative of an overall market that wants to rally, and we'll see a rally across the board, particularly on the S&P 500, Nasdaq, and the Dow, and probably IWM comes up and retests their highs. All right, so that covers the four major markets and my thoughts on what's going to happen. Like I said, if someone's looking for a little bit more clarity, sorry, that's all I got for you. But it's really a coin flip until we see what these earnings reports are going to give us. Like I said, that's why a lot of times during these parts of earnings season, I tend to stay away from directional trades, is because it's often very unpredictable. And as you can see, the market's just waiting to see what those reports tell it, and then from there it'll get a better gauge of what it can expect for the next quarter or so. Let's take a quick look at the U.S. dollar. We'll look at oil, gold, and silver, and then we'll take a quick look at cryptocurrencies, then we'll move on to chart requests. Those of you in here, like I said, if you have a chart you want me to look at, or if you have a question about anything I just pointed out, just type it into the chat. I'll be more than happy to take a look at it and give you my thoughts on it. Now, as you can see, the U.S. dollar is still struggling. It's still dropping, kind of stair-stepping down. Lost a lot of momentum that it had actually built up. You can see that the dollar had actually done a really good job of bottoming out, and beyond that, actually breaking back towards the upside, putting a lot of pressure on other currencies, particularly in the euro. Now that has not lasted long. You can see we came back, and typically, if we're in the beginning of a new bull trend, this would have held, and we would have bounced off of that. But we faded right back into this range. It's not necessarily the end of the world. I think that this is still indicative. This is indicative of a U.S. dollar that has bounced and has stabilized, but it's not really ready to start climbing yet. If we look at the euro-U.S. dollar, it's going to be an inverse of that. And you can see, again, in this case, up is good for the euro. You can see that the euro was able to kind of return and kind of reclaim the momentum back from the U.S. dollar, and it did so once it was able to break past this 118, and then once it was able to get past 119 and get back up into this range, it did a good job of kind of stabilizing and staving off what was going to be a big breakdown, or what was already becoming a big breakdown as it made its way back up to the 117. So I think more than anything, this shows that the U.S. dollar is still weak. However, I think it's probably bottomed out, which means that the euro is probably stuck in a range. I don't think it's going to come back up and trade above 123 to 124. I think if anything, it'll kind of meander its way back up to 121 and probably find very stiff resistance there, at which point it'll stall out and either try to make a move back up or then drop back into its moving averages. Not really a clean spot right here for a trade one way or the other. If we look at the US yen, we'll see. Now this is the one currency cross as far as the three that we like to watch where the US dollar has still exhibited some strength. It had a very strong rally versus the yen and really kind of ran up all the way up to the 110 area, and then it kind of pulled back recently with the recent dollar weakness. But as you can see, it actually has already started to kind of rebound and reclaim some of this lost territory, as opposed to what we saw versus the euro and what we'll probably see versus the Canadian. Struggling with the moving averages, but I think overall this is still indicative of a U.S. dollar that is probably still going to try to climb versus the yen. However, at this point, it's not that easy of a trade because it already kind of ran up over the last 3 days. So we want to see if it consolidates, comes back to maybe 108, and puts a little bull flag, then maybe it's worth a trade to the long side. And then finally, the last currency cross we want to look at is the U.S. Canadian. As you can see, the U.S. dollar really struggling versus the Canadian. Again, oil is green. If oil's green, the U.S. Canadian is probably down. And it's really struggling to maintain any kind of a semblance of steady price action. It just continues to just drop. And part of that, of course, is the oil just continues to kind of make its way back up. Now, in this case, we've been watching oil, and we were expecting a bounce, right? We had this nice consolidation range. We had a little bit of a bullish breakout on it. It came up, it retested 63.70, which we expected to be resistance. It pulled back. And as you can see, it found support right at its moving averages and came right back up. Now, like I mentioned earlier, when you have a range, right, and you come up, you test the top, you come back down, you come up, whether you break out or not, you come down and you test the bottom of it, then you test the top, and then the next consolidation, you only consolidate maybe halfway or less. Usually that indicates that the momentum is probably going to be enough to break out. So in this case, I would expect this breakout to hold, and I'd expect it to make its way back up to the 66 area, and then see what happens as we hit that new level of supply. So I expect energy names to probably benefit from this and to rally, and probably that rally will continue at least for another day or two, and see what happens as we hit these levels. And again, that's going to bode poorly for the U.S. Canadian currency cross. This is indicating again an increased demand for energy, and that our economy is opening up more and is more comfortable with higher energy prices. And so I think overall this is probably still a good thing, although like I said before, I'd rather the oil sort of stabilizes here rather than really runs up. I think if it runs up too fast, it could put a lot of pressure. So I'd rather it kind of stalls out here. But again, what I want is not going to have any impact on what it does. So let's just see what it does here and see whether it makes its way back up to 66. If it stalls out and comes back to its moving averages, then it clearly was not ready to push upwards, and it'll come right back down to 58. And any energy name we're looking at will likely falter as well. So it's important if you're trying to trade any oil names, whether it's drillers, refiners, anything of that nature, watch to see what crude does. And then finally, the last two commodities are gold and silver. Gold has printed a nice pattern here where it was able to kind of break above this little double bottom that it formed, and it's printing a decent flag here. I'm still not that excited about it. I think there's so much overhead pressure on it, and it's such a sloppy trade right now when you look at the long-term price action, that I just feel that there are better opportunities elsewhere. However, that being said, this is not that bad of a style of trade here for those that are into this. You've got the double bottom. You've got the nice little bull flag. After it already kind of broke out. So there is potential for a move back up to 168 and probably all the way up to 174. So if someone is a gold bull and wants to try to take their shot at this, this is not a bad risk-reward scenario because, again, you've got support around 164. Anything below that is a stop out. And then above that, you've got a decent amount of potential to the upside. However, I feel like there's better opportunities elsewhere. But that is actually not that bad of a trade. And again, it's going to be a very similar picture with silver. And silver, if anything, relatively speaking, might be a little bit better off. But we've got the same sort of pattern developing. Now with silver, it's a little bit more tricky, but because really our support level is all the way down here. And even this pattern here is difficult. What I would say with silver is that, if anything, we've got a level here which is going to be important for it to clear. And once it clears that, then I think it's okay to kind of move its way upwards. But overall, like I said, both of them are set up decently, but I don't know that the upside is still worth it compared to what we see in other spots, particularly when you look at their long-term trends. They're not bullish right now. They're trading sideways or down. And then finally, we have Bitcoin and Ethereum. And Bitcoin actually is not in a great spot as well. I don't think it's in a bad spot, but it's not in a good spot here for buy. This is another one very similar to what we saw in the IWM and the Nasdaq charts, where you have a clear trend and then you have a breakdown, and now you're coming up and retesting that breakdown. That usually doesn't end up well. Usually that first retest fails, and then you come down and then you either form a channel, which you eventually, or sideways range where you eventually break back out to new highs, or you kind of roll over and start testing lower. And so Bitcoin is still in that process right now, where it's coming up to retest the breakout from the breakdown from its last trend. And like I said, it normally doesn't react well to that first test, and then it comes down, and then it's really what happens after that that becomes important. And so it's not in that great of a spot as well. However, Ethereum actually is in a much different spot right here, and this is another type of rotation that occurs in the crypto markets, is the move from Bitcoin towards Ethereum and other altcoins. And so what we have right now is we have a dichotomy here where Bitcoin is maybe struggling a little bit, but we're having some pretty big moves on some smaller cap names that are really related to Ethereum. As you can see, Ethereum's at new all-time highs, and it's done a much better job of recovering from that sell-off that we saw in the middle of April. Across the board, a lot of cryptocurrencies took some hits during that time, and Ethereum has rebounded nicely, and some of the stronger altcoins have rebounded as well, without pulling back as sharply. But there has been some carnage on some others, and they're only now starting to recover some of the drops that they experienced. And so we're seeing a little bit of the same thing with the crypto space that we are in the stocks, which is a little bit of rotation back and forth and a little bit of correcting from what was a pretty strong bull rally. All right, so that covers it as far as what I want to look at as far as the cryptocurrencies and commodities and the stock markets. If anyone in here has a chart they want me to look at, now's the time to do so. We'll see what we have, and we have a little bit of time to kind of go ahead and take a look at what you guys are looking at. We haven't had too much successful trades so far today or this week as far as what I've been looking at with Patreon. Like I said, I recommended taking it very light last week and this week. I'm not expecting a lot of potential, and neither of the trades that we're looking at has done much. We're looking at a possible bounce play on Netflix, and that's still in the cards, and it's still kind of trying to stabilize here at 500 and maybe try to rally. And I think that this is going to be based off of what we see in the overall Nasdaq. And then the other one we want to look at still hasn't materialized as well, which is with the Walgreens Boots Alliance. And as you can see, Walgreens still kind of struggling a bit, still trying to finish this descending wedge, but at good support, still good risk reward. We just haven't seen we haven't seen the price action really trigger and give us an entry signal. And like I said, that's what I've been looking at, trying to avoid really taking too many swing trades at the moment during earnings season, but trying to keep it as safe as possible with very short or very, very small stop areas. All right, so Ray, you want to look at the Nikola Corporation. They've actually been struggling. A lot of the, there was a lot of momentum in some of these electric car names. They've kind of stalled out a bit. These guys, so they had their earnings, and it was not a good earnings, and they've been kind of bleeding down. I imagine you're looking for an entry. I want to do two things. One, let's see if there's a trend that actually can connect here. Alright, so long term, you can see that this is still in a pretty clear downtrend, right? Now that doesn't mean we can't trade this. I'm not trying to like sway you from I'm not trying to sway you from looking at a trade in this, but you have to understand when you see something like this, very similar to the gold and silver, when you have a stock that's trending very steadily down like this, you're trading against the momentum here, right? So in this particular case, you have to understand you need to be aggressive about entries and exits, particularly about exits, both whether you're right or wrong, because it can continue to bleed against you in the wrong direction, right? So there have been opportunities here where it bounced, and if you didn't take your profits at the right time, you ended up not only losing potential profits, but it actually broke down below whatever your actual entry was. So first thing I like to do with something like this is let's take a look at the long-term picture and see if there are any clear levels that develop, right? And I can see a couple here. They're a little sloppy, but they're still levels that we can identify, right? One of them is probably right around here. There's another one above it, right here, right? And then shorter term, not quite as significant, but there's a level that's developing or developed right around, I would say just above that, like right around here, right? So we have an idea now of where there will be potential sellers on something like this, right? And I do think this looks like it's a potential bottom, right? We had the poor earnings report. We have volume increasing as it tries to bottom out. So now we can zoom back in. That we have a clear picture of what's going on here. And so we have a little bit of a roadmap of how we want to go ahead and try to trade this, right? So now we could do is another trend line here. As you can see, it's really struggling to break this 1250 area, right? So if it can actually break it decisively, then we can enter here, right? If it fails, well, the problem I have here is that we don't have a good stop out point. For a stop, I would say we have all the way down here, right? Because that's really that's the first. Besides the obvious stop all the way down here, 936, which we don't want to take because that's way too far for us. That's too much. That's too much room to give it for a stock that's in a downtrend. Considering our upside is a lot more limited than you would expect. I think if you look at something like this, you might think to yourself, well, this thing could go to 30 or 40, but the truth is that we really shouldn't expect it to break this downtrend, which means absolute upside is probably going to be somewhere in the 17 range. And even then, that would be pretty optimistic, right? Because I would not expect it to be able to break that downtrend unless it had either good earnings support or it took a few tries to really break through it, right? So if we're looking at upside here, we've got probably about $5 of upside, and then to the downside, we've got, maybe 3 or 4 if we went all the way down here. However, downside is much better if we go to the bottom of this hammer candle, which was the big volume spike. So I think any move below about 1090 would likely lead to a move down to 960. So you might as well use this as your stop out, right? So that gives us about 1.5 points of downside, which means that probably this first level is not going to be a good scale out point, but this is the first expected area that we would find resistance as it comes up and hits the 50 as well. So you probably want to scale out of a portion here, even if the risk reward's not great, because it could just return right back. But the key area to watch, or the big target, would be the 1750 area. Okay? So if I were to look at this as a potential trade, I probably would shy away from it because I like to have at least 1-to-1 risk on the first target, and we're not really getting that here. We're getting about a dollar. Actually, it's pretty close. $1.40 of upside and about $1.60 or 70 of downside. So it's not quite where I would want it to be. But basically, that's what I'd be looking for. I'd be looking for a breakout past this. I would expect resistance up here around 1380, and then I'd expect even more resistance around 1750, which again would probably be right around where this trend line comes down to meet price. Okay? So that would be the roadmap of how I would want to trade this. Like I said, I think it had a good rebound here, right? It had a really high volume. This is a nice reversal pattern. However, it's had these patterns before, and they've ultimately failed. So I wouldn't get too excited that this is the one that's going to push it back up into the high 30s and 40s. I think that what you're looking at here is a potential bounce play. Now, if this is something you're looking at as a long-term hold and something you want to trade in the long term, then you still want to play this as a swing trade. You want to buy here, and maybe you skip this as a potential scale out, and over here you take small profits, and then you wait for a pullback to this area, and then you scale in more, and then once it breaks this, then you could feel like you have more room for a move back up into the 200 and then maybe into the $30 range. But if I were to swing trade this, like I said, I would be looking for an entry. I'd scale out maybe 30% here. I'd scale out like a 40 or 50% here, and then I'd hold a small, maybe 20 to 10%, looking for a big breakout, and know that I can make up for it just with the kind of upside it would have if it did break out, but without risking any of my profits. And again, I'm not sure. Well, it looks like it has earnings now coming up soon. I'm not sure why I would have earnings in February, and then again, has it already been? Yeah, okay, so yes, it's been 3 months. So, actually, another reason probably to stay away from it, it's supposed to report earnings pretty soon, 9 days, okay? So, keep that in mind, Ray. I know you might get excited, because I know when you get into these stocks, you kind of put your horse blinders on and you stick to them. Understand you only have 9 days before you expose yourself to undue risk. So keep that in mind if you do want to trade this. However, this blueprint is how I would go ahead and play this if there wasn't earnings. Because there's earnings so close, I think I just avoid this altogether. Okay? Alright, well, thank you, Ray. Good to see you. Hope everything's going well with you. Whoever else is in here, thank you for attending. I hope that you are getting what you can out of this as well. Like I said, if anyone in here has a chart request that comes up during the week, or maybe you don't want to ask on Twitch, you can always find me on Twitter at the name @StockDarts. I'd be more than happy to send you a chart through that, or you can email me stockdarts@gmail.com, or visit me on Discord or whatever, and I'd be more than happy to give you guys my look on whatever chart you're looking for. Other than that, I hope you guys have a good rest of this week. Keep an eye on those earnings, and we will meet again next Wednesday.